Okay, let's take a look at this problem. And as always, it's always a good idea to make sure we know what we're talking about. This company offers a restricted stock plan. The company granted 30 million of its dollar par shares, subject to forfeiture. So these are the kind of plans that we will record, and then we will kind of amortize them over the life. The common shares have a market price of $8 on the grant date. Okay, so the first part we need to do, it says what's the total compensation cost? Well, it's 30 million shares times $8, 240 million. Now, we're not taking that as expense this year. We're going to use that up, okay? And the vesting, or the period that we're going to use it, is the 2 years, because if the vice president leaves within 2 years, they're forfeited. So we're going to recognize a little piece of this each year. So, December 31st, 2013, we're going to recognize half of that. Okay, so $120 compensation expense, salary expense, wage expense, whatever you want to call it. It's an expense, goes on the balance sheet, in the income statement rather. And paid in capital restricted stock, 120 million. Now keep in mind, this is paid in capital for restricted stock. We're going to change that after the 2-year period is up. Then the next year we have another 120 million, because remember, the employees have to stay 2 years. So the period of benefit is 2 years, so we use this up over 2 years by recognizing half each year for our compensation expense. Once the 2 years are finished, we're then going to reverse out these two entries. Okay, so we're going to have paid in capital debit 240 million. That makes these two go away. We're going to have common stock, dollar par, so 30 million shares at $1 each. The additional paid in capital is 210 million. And look what we've done. We recognized the total compensation that we might spend over the next 2 years. As each year goes by, we recognize that half is earned, but we keep it in this clearing account, this temporary account, this suspension account called restricted stock. And once the vesting period has ended, they now have right to that stock. They can do what they like. So we empty out the paid in capital restricted stock and move it all to common stock and paid in capital in excess of par.